I want to tell you a true story about a recent case that has been published, and it's a lesson for all of us. In this case, there was a simple error that everybody accepted was an error, and that no one had any power to help, but only to sympathise. The story starts with the company raising funds under the Seed Enterprise Investment Scheme, which is a way to encourage outside investment into small startup businesses that may otherwise find it difficult to raise funds. So firstly, a little bit of background. The Enterprise Investment Scheme, which is the Seed Enterprise Investment Scheme's big brother, is a tax reducer, and the tax is reduced by 30% of the value of subscriptions in qualifying shares. There are criteria for the investor, the shares and the trade to qualify under the scheme. Under the Seed Enterprise Investment Scheme, an investor can invest up to £100,000 per annum across various companies and will receive tax relief at the rate of 50%, again as a tax reducer. So there is a significant difference between the two schemes. But here, ex-Wind Power submitted an EIS claim which was granted, and the rate of tax relief was fixed at 30%. The problem is that the company should have submitted an SEIS claim, and the investors should have received tax relief of 50% and not 30%. The company then sought to submit a correct form, but this was rejected by HM Revenue and Customs because the earlier EIS application prevented the company from a subsequent SEIS claim, and HMRC were not permitted to retrospectively withdraw the original EIS application. The company appealed against the HMRC judgments, and the whole thing went to a tribunal, where it was disclosed that the managing director's personal assistant had made an innocent error and completed an EIS form by mistake, which the MD failed to notice when he signed the form. The company lost at the tribunal because the judge had no authority to overturn the original application. He was very sympathetic, but could do nothing. I want to round off with a brief summary of the Seed Enterprise Investment Scheme in case you think it might be useful in your own particular situation. It is designed for companies with less than 25 employees, less than £200,000 in assets, and have been in business for less than 2 years. The company can raise up to £150,000, which contrasts with the EIS scheme, which is £5 million. There are some major incentives for the investor. They get 50% tax relief as a tax reducer, but they mustn't hold more than 30% of the shares in the company. They can invest up to £100,000 per annum, spread across a group of companies. The shares must be actually subscribed, but if they're held for 3 years, then any gain on the sale of those shares will be tax-free. There is also an element of reinvestment relief if you're realising other assets to invest in the shares. As with all legislation of this type, there are a lot of rules and regulations that need to be complied with, and we can barely scratch the surface here. But here are a few more of the more important ones. The shares must be held for 3 years, the company must remain SES compliant throughout that time, and the investor must be over 18 years old. The shares must be paid for in cash and in full, so you can't buy the shares on credit. And the investor must not be employed by the company. So in conclusion, we can say that both EIS and SEIS are very useful ways of encouraging outside shareholders to invest in your company. We have seen both of these used to good effect on our patch. But, as we've also shown, it is very easy to get things wrong, and it's good to get us involved at an early stage. I'm Alan Long from the Long Partnership, making life less taxing.